Hi, it's Damien, and today I'm coming live and direct from a brand new studio in the loft.
Hello.
It's full of dust and kind of creepy, but the missus was sick of me trashing the spare bedroom, and I just have to keep reminding myself that there's nothing living in the crawl space. A lot of subscribers are here because of the video I made on investing in the Vanguard Lifestrategy funds, which are a well-diversified, one-stop shop investment offering you access to thousands of companies with just one purchase. But today I want to look at a couple of other funds that Vanguard offers, and also help you guys decode the mess that is their names, as this channel is all about giving you the tools to understand the investments that you are making. I'm going to pick out two main funds for us to take a look at, but really what you're going to take away from this video today is a process to assess what's inside of an index fund, how much it's going to cost you, and what the hell all those little weird letters mean at the end. And by the end of this video, you're going to understand that really it's quite easy, and that you don't need to be an expert to understand what's going on here. While I'll be using screen grabs from Vanguard's website as I have an account with them, this video applies to all providers. As let's face it, if you're using index funds, 80% of the ones that you're going to come across are going to be Vanguard's. First things first, let's start with a question. If the Lifestrategy fund is an all-encompassing, well-diversified, one-stop shop investment, why do I need to be considering other index funds? In short, you don't. It's my opinion that the Lifestrategy is a perfectly adequate investment vehicle, gives you exposure to the whole world, and will likely remain sufficient for anyone who wants to invest long term. But I do think there are two reasons why a beginner investor may look to branch away slightly from the Lifestrategy funds. Number one, to supplement the Lifestrategy fund. And number two, to put together your own investment mix. So first of all, let's look at number one, supplementing the Lifestrategy fund itself. Have you ever walked into a restaurant, sat down, whipped out the menu and found a meal you like? Let's call it a roast dinner. Now let's say you commit to eating that roast dinner, but before you order it, you see there's a section on the menu titled sides. And while you understand that that roast dinner is a perfectly adequate meal, and that if you eat it, you will be fine, I need me that mac and cheese side. The second reason is you want to be the chef. Some people go into a restaurant, sit down, eat the meal and leave. They like it because it's convenient, easy and requires little effort. Other people sit down to eat and want to deconstruct the meal in front of them, figure out what it's made of, or even cook it for themselves. Understanding how to decode the mess that is the name of index funds and what they contain means you can then sit down and plan an all-you-can-eat investment buffet of your own that's based on your decisions and your own logic. The two funds we're going to consider today are the S&P 500 UCITS ETF VUSA and the FTSE All-World High Dividend Yield UCITS ETF VILE. I'll also point out some alternative funds alongside these that are similar but have different characteristics that you may wish to consider. First things first, let's break down the name a little bit. Said as one, they are so confusing. But you wouldn't greet me by my full name every single time you met me. So you don't need to do that with an index fund either. Let's start at the back with those four weird letters and see if we can figure out what they mean. VUSA, VILE, VIL, VILE.
Hip hop? Hip hop anonymous?
It looks like absolute gibberish, when in fact it's actually just an abbreviation of the full name itself. VUSA is the S&P 500 UCITS ETF. The V in VUSA stands for Vanguard. The USA in VUSA stands for USA, as in United States of America, because this is a Vanguard fund that invests in the top 500 businesses in America. It's like it's a nickname. So rather than typing out S&P 500 UCITS ETF every time, you can just put VUSA into Google and you'll get all of the information that you need. If I was an index fund, at the end of my name, it would say, wait, no, that's not right. It would say Damo, D-A-M-O, Damo, Damo. Only ETF versions of the funds have this little name. I cover the differences between ETFs and index funds in another video. All I want to be clear on here is if you're buying ETFs, just don't pay a dealing fee. You can either use a free broker like Trading 212 or Free Trade, or if you're on Vanguard, you just simply click here instead of here. And as long as you click here, everything on this page is then without dealing fees. Jumping to the front of the name, you have things like S&P, FTSE, and on some of the alternative investments, ESG. In the restaurant example, this is either the name of the chef or probably a better way of putting it is this is the name of the restaurant. S&P, FTSE and ESG are the people who compile the menu. Their full names are Standards and Poor, FTSE Russell, and Environmental, Social and Governance. The first two, S&P and FTSE, are basically credit rating and stats companies. They're the people you go to if you need to know who the 500 biggest businesses are in America, or the top 100 are in the UK. It's kind of like if you go to Forbes because you want to know who the richest people are in the world, or you go to Michelin to find out where the best restaurants are, just a lot more detailed. S&P is an American business and FTSE is an English one, and they are just the people compiling the list of businesses that Vanguard's index funds aim to track the performance of. So this bit at the front is like them sticking their brand on it saying, FTSE compiled this list or S&P compiled this list. The third one, ESG, is like having a fair trade stamp on a packet of coffee. If this is at the front of an investment, you know that the companies that you're investing in are acting responsibly and not destroying the world. Basically, it's a sign that you're engaging in socially responsible investing. UCITS is basically a stamp to say that this fund complies with certain regulations that allow it to be sold across Europe. You'll see this a lot because it's basically just a sign that this fund is allowed to be sold across Europe. Which leaves us with just a few words. And this is the key information. This is what the fund consists of and what it's looking to do day to day. So the All World High Dividend Fund. I'm going to take a stab in the dark here and guess that this is a fund that focuses on dividend paying companies from all over the world. You don't need to guess though, just Google the name of the fund and you can even just Google the 4-letter nickname if it has one. Vanguard always has a page that comes up and on here you can see a load of information. But under the overview section, first of all you have a number of companies your money is spread over, and secondly the cost. The cost in this case is stated as 0.29%. Well, basically every year 0.29% of the total I have invested in the index fund is taken as a fee. The costs on all Vanguard index funds are exceptionally cheap. When they entered the UK market, they actually forced everyone else to drop their fees, they were that much cheaper. Fees do vary from fund to fund, and generally the lower the fee the better. If you now scroll down to the objective section here, the line you are looking for is as follows. Seeks to track the performance of the FTSE All World High Dividend Yield Index. Remember guys, that S&P and FTSE are the guys who compile the lists of the biggest businesses in the world. This is Vanguard saying in this example, we're going to use FTSE's list of the best dividend paying companies across the world. That is the index. And Vanguard's index fund is a fund of money that tracks the performance of that index. So you can take this index that Vanguard are going to track and Google the name of that. Pro tip, if you add fact sheet to the end of the search, you can normally get a download with everything on it you need, including the companies that are listed on that index that your money will be invested into. If you want to know about historical performance, all that info is also on Vanguard's overview screen. You just scroll down and here it is. So that's how you figure out what's in the fund. And really when it comes down to it, it's not rocket science. You don't need to know the ins and outs of every single business that you're investing in through the index. This is why this is a suitable investment for beginners. It doesn't require heavy amounts of technical analysis. All you really need to understand is what are the costs involved and what does the index fund look to track over the long term, and does that investment make sense to you? I would also say it's important to quickly check how closely the index fund has been able to track the index in the past. They're never going to be able to do it perfectly, but it should be pretty close. You again can check this on the overview screen here. Where it shows past performance, the grey section is how the fund performed, the green section is how the index performed, how the list of businesses has performed. Notice how it's basically the same, but there is a slight difference. When looking at this, you want to see that the two charts basically look the same, with no clear and obvious differences. Remember that the index fund looks to track the performance of a list of businesses set out by FTSE Russell or Standards and Poor. And while it can follow it closely, it can never copy it perfectly. That's impossible. So there's always going to be a slight bit of discrepancy, don't worry about that. Just make sure that the end result isn't vastly different. With Vanguard, honestly, this is never really an issue. Now let's quickly take a look at why you might start to supplement the Lifestrategy fund with a few of these additional index funds and run through a couple of examples of funds that I've picked out. I just want to stress at this point, these are not recommendations. I only picked out these funds because they serve as good examples for the things I'm talking about. So first of all, there's a feature of the Lifestrategy fund that has recently had me thinking. In the UK, our Lifestrategy funds are weighed towards the UK market. They contain shares from all over the world, but a large proportion of the holdings are in the UK. The American version of the Lifestrategy funds are the same, but they're weighted towards America. This is done intentionally because people often feel more comfortable investing in companies that they know. But the UK over the next couple of years faces some uncertain times. I mean, let's face it, the whole world does really. But in the UK, not only do we have the issue that everyone else is facing, we also have our political issues. But on the other side of the pond, the biggest tech companies in the world are having an absolute great time. And to be honest, I can't really see it stopping. So I've been supplementing my Lifestrategy fund with an extra S&P 500, the top 500 businesses in the USA. Only really because I want more exposure to those tech giants. Because all of those tech giants really are American companies. That's my mac and cheese side. I just want to be clear here that the Lifestrategy funds already include these big American tech companies and the whole of the S&P 500. I'm just placing more chips on the same number, increasing my exposure to those businesses. So the S&P 500 is the top 500 businesses in the USA, or as an alternative you could use the US Equity Index Fund ACC, which is all of the American businesses. So by betting on all of the American businesses, you're basically betting on the whole American economy at once. Rather than just saying, I think the big businesses will do well, you're saying, I think America will do well overall. The ACC at the end of that name stands for accumulation. All that simply means is any income that you receive from the businesses, so when they pay you profit in the form of dividends, that will be reinvested back into the index fund. I always reinvest my dividends because it creates a snowball effect. But whether the fund says accumulation ACC or income INC, with the income versions just paying the money straight onto the platform, it's either automatically reinvested or you reinvest it yourself by hand. Either way, it doesn't really matter, as long as you're reinvesting the dividends in some way, shape or form. If you don't want a UK weighted investment and you can't be bothered supplementing or watering down your Lifestrategy fund, but want the worldwide diversification by spreading your money across a large number of countries or companies, you could always look at the section of funds that have a world focus. Just click the section that says world here. So one I've picked out, not because I recommend it, but because I think it's interesting, is the FTSE All World High Dividend Yield UCITS ETF VIL. Just as a recap to remember, VHYL is just an abbreviation of the name that you can search. UCITS is a stamp to say that this fund is regulated correctly and can be sold across the whole of Europe. FTSE is the company that compiles the list of businesses that this fund aims to track. And when it comes to what that list is, it says in the name World High Dividend. So essentially FTSE have compiled a list of companies across the world that normally pay a high dividend, and then Vanguard have created a fund to track that list of companies. If you search the topic of investments on YouTube for any amount of time, you're likely to come across content creators talking about dividend portfolios. They'll be talking about the benefits of investing in companies that have a track record of paying a large amount of their profits to their investors. Andre Jick, for example, who I really like, in his dividend portfolio, he has over 150 different companies. That's a lot of research and a lot of work to maintain. This fund by Vanguard is a well-diversified, off-the-shelf, ready-made dividend portfolio, where you know that whenever you purchase this fund, the money is being spread across companies that have a proven track record for paying high dividends. Simples. Or alternatively to this, let's say you want to make a positive impact on the world, or that at least you want to make sure that the companies that you're buying aren't doing anything that doesn't align with your own morals. One of the issues with buying funds is there's hundreds of different companies in there, and they include all of the companies that sell guns, tobacco, alcohol, etc. If you want to know that the investments that you are purchasing are in line with your own morals, then buy a fund that has ESG at the front. Interestingly, the ESG Developed World All Cap Equity Index is actually slightly cheaper than the high dividend fund we just looked at, and we love it when it's cheap. And the index it's tracked is called the FTSE Developed AY Controversies, Non-Renewable Energy, Vice Products and Weapons Index. You can look that up, but to save you a job, basically that index is a list of companies that operate all over the world, but they don't sell guns and tobacco and things that people get addicted to and all of the nasty stuff. It is possible to be socially responsible when investing, and Vanguard are making it really easy for you here. Again, if you want to know what the actual companies are inside of the index, just Google the name of the index fund, go on the Vanguard website, find that sentence about what the fund aims to track, and Google that name with fact sheet at the end. At the end of the day, I can't tell you what to invest in. That's up to you. But the Lifestrategy fund has everything a beginner needs to start learning about investing and to pick up the basics. It's my opinion that establishing the habit of investing every month is far more important at this stage of your journey than it is to focus on picking the absolute very best investment first time around. I hope today I've shown you how to dissect these funds a little bit so you can start to have a little bit of fun with them and maybe branch out a little bit. It isn't complicated, they're designed to be easy to use. You don't need a degree in quantum mechanics just to figure out what's in the index and how much it's going to cost you on a monthly basis. Just like you don't need a degree in computer science to hit the subscribe button. In a future episode, we'll start to look at the analysis techniques that I use when looking at individual companies. But don't forget, it's a marathon, it's not a sprint. Speaking of sprint, I'm going to get the hell out of this creepy loft. Who turned the lights out? Is someone there?